Imagine a stock chart as an obstacle course. Under normal conditions, the price of a stock creates a continuous path. It moves up and down based on the day-to-day momentum of human buyers and sellers pushing it along. But every so often, the path simply disappears. Our runner is forced to confront an empty space, with the next section of track hovering much higher or much lower than where they currently stand. In the financial world, this empty space is a price gap. It happens when zero trading occurs between yesterday's close and today's open. Usually, a company releases major news overnight, causing buyers to instantly adjust what they are willing to pay the second the market opens the next morning. Looking at a gap like this, our runner has to make a choice. They need to know if this massive leap is the start of a long marathon or a final, desperate burst of energy before a crash. To find out, we look at the runner's physical behavior. We check where on the path the leap happens, how much energy they exert, and whether they have to double back to cover that empty space. Let's start with a crowded section of the course. The market is stuck in a flat, sideways stretch called a congestion zone. Buyers and sellers are just pacing back and forth in a tight circle. Suddenly, the price makes a little hop upward. This is an area gap. It happens entirely within that sideways crowd and lacks real momentum. The runner jumps but hooks right back around almost immediately. In investing terms, we say the price returns to close the gap. Within a few days, the stock falls back down, covering that empty space with new trading activity. This leap has no long-term significance. Other times, the market decides to leave the sideways crowd behind entirely. This is the breakaway gap. It is a massive, aggressive leap that launches a brand new upward climb. Below our runner, notice the energy meter. That represents trading volume, the actual number of shares changing hands. A true breakaway gap is powered by a massive spike in volume that stays high. The runner finds their stride, sprinting upward for months without ever looking back to close that initial empty space. An area gap is a meaningless warm-up stretch. A breakaway gap is the high-energy launch pad needed to start a profitable trade. Let's jump ahead. Our runner is now miles into the race, confidently navigating a steep, established upward climb. Right in the middle of this steady stride, they take a smooth leap forward. This is a continuation gap. It's a burst of second wind that happens once the trend has built up enough velocity to leap forward without stopping. Because this leap happens once the trend has reached its peak cruising speed, it serves as a reliable halfway marker. We can use the gap as a ruler. Measure the distance from the bottom of the hill to the gap, and project that same distance forward to see where the peak is likely to be. But every climb eventually runs out of road. At the very top of the mountain, the runner's stamina is finally drained. Here, we see the exhaustion gap. At first glance, it mimics a breakaway gap because it's a massive leap upward with a frantic spike in volume. But because this jump happens at the end of a long, tiring trend, the runner instantly collapses. The price slides backward, rapidly closing the gap in a matter of days, as the upward trend officially ends. Mistaking an exhaustion gap for a breakaway gap is a common trap. It leads investors to buy right at the finish line, just moments before the market slides back down. When we zoom out, the entire journey becomes clear. We see the explosive breakaway gap at the start, the steady continuation gap in the middle, and the collapsing exhaustion gap at the peak. To understand any gap, look at its context. Analyze its place on the path, the volume of energy behind it, and how quickly the price closes. This advanced micro-devices chart shows these rules in action: a breakaway gap launching the trend, a continuation gap, and an exhaustion gap at the top. Notice how the continuation gap acts as the exact midpoint between the initial launch and the final summit. A stock chart is a map of human momentum. Once you learn how to read these empty spaces, you can see the life cycle of a trend, knowing exactly when to jump in and when to safely walk away.